Today, I want to talk about something that has been making headlines recently, the Federal Reserve's decision to hike rates by 0.25% point. Many of you may be wondering what this means for your investments and the economy as a whole. Well, let's dive into it and break it down. But first, if you value the information I provide in this video, please hit the like button, and if you haven't done so already, consider subscribing to my channel. Now, let's get into the video. Before we get into the specifics of the rate increase, let's first talk about the Federal Reserve. The Federal Reserve, or the Fed, is the central bank of the United States. It's responsible for implementing monetary policy, which involves controlling the money supply and interest rates to promote economic growth and stability. One of the key tools the Fed uses to implement monetary policy is the federal funds rate. The federal funds rate is the interest rate at which banks lend money to each other overnight. It's a short-term rate that affects many other interest rates in the economy, including those on loans, credit cards, and mortgages. Now, let's talk about the recent rate increase. On March 22, 2023, the Fed announced that it would increase the federal funds rate by a quarter point. This may not seem like a significant increase, but it can have a ripple effect throughout the economy. One of the main effects of an interest rate increase is that it can make borrowing more expensive. This is because banks and other lenders will raise the interest rates they charge on loans to compensate for the higher cost of borrowing money themselves. This can make it harder for people and businesses to borrow money, which can slow down economic growth. On the flip side, an interest rate increase can also make saving more attractive. This is because banks and other financial institutions will raise the interest rates they pay on savings accounts and other deposits to attract more money. So, if you're a saver, you may benefit from the rate increase by earning higher interest on your savings. Another area that can be impacted by an interest rate increase is the stock market. When interest rates rise, investors may shift their money away from stocks and into bonds or other investments that offer a higher return. This can cause stock prices to fall, which can hurt investors who are heavily invested in the stock market. Now that we've covered some of the potential impacts of an interest rate increase, let's take a look at the history of rate increases. Over the past few decades, the Fed has raised interest rates to combat inflation and lower them to stimulate economic growth. The most recent rate increase in 2023 is part of a larger trend of raising rates in response to higher inflation. So, why is the Fed raising interest rates now? The main reason is to combat inflation. Inflation is the rate at which prices for goods and services increase over time. When inflation gets too high, it can hurt the economy by making it more expensive for people and businesses to buy things. By raising interest rates, the Fed is trying to slow down the economy and prevent inflation from getting out of control. Inflation has been rising steadily over the past year, driven by a number of factors such as supply chain disruptions, labor shortages, and rising energy costs. The Fed has been keeping a close eye on inflation and has been signaling for months that it may need to raise interest rates to combat it. The Fed has also released its latest economic projections, which show that it may raise interest rates more times over the next few years. The projections show that the Fed expects inflation to remain above its 2% target for the next few years, and it believes that raising interest rates is necessary to keep inflation in check. So, what does all this mean for the economy? The truth is, it's hard to say exactly how the economy will be impacted by the rate increase. It will depend on a number of factors, such as how consumers and businesses react to the higher borrowing costs, how the stock market performs, and how the Fed's projections play out. However, there are some general guidelines that investors can follow in light of the rate increase. For example, investors may want to consider investing in bonds or other fixed income securities, which can offer a steady return even if the stock market declines. Investors may also want to consider diversifying their portfolios across different asset classes, such as stocks, bonds, and real estate, to spread out their risk. Finally, it's worth noting that different sectors of the economy may be impacted differently by the rate increase. For example, companies that rely heavily on borrowing, such as banks or real estate developers, may be hurt by higher borrowing costs. On the other hand, companies that have a lot of cash on hand, such as tech companies, may be less impacted. The rate increase may also impact different demographic groups in different ways. For example, older adults who rely on fixed income investments may benefit from the higher interest rates. But younger adults who are just starting out in their careers may be more impacted by the higher borrowing costs. So, there you have it, an overview of the Federal Reserve's recent rate increase and its potential impacts on the economy and investors. As always, it's important to keep a close eye on the markets and adjust your investments as needed. I hope you found this video entertaining and learned something new. If so, kindly click the like button and subscribe to the channel. Don't forget to tell your friends about the video too. Additionally, if you have any questions or remarks, please comment below. Thank you for watching, and if you enjoyed this video, check out the video we made on how you can retire at any age. See you in the next video.